Welcome to Global Alternative Investment Webinar 2020. This is our second time official webinar series. We are focusing on the global real estate investment market today. And this webinar is hosted by eDaily, one of the Korean economic newspaper company, and Zero In, which is sister company of eDaily. Zero In is one of the major consulting firm in finance area in Korea. So I appreciate for both eDaily and Zero In to make this event happen. And then I appreciate all of your time and effort for this webinar. All right, the topic again is how do we assess, how do we evaluate global real estate market? What are the risks and opportunities we are facing in light of COVID-19? As we know, we have a first and second GFC, Great Financial Crisis, 20 years ago, about 10 years ago, and we have experience from the two different GFC, the huge value discount and decrease in global real estate market. However, unlike the past crisis, this time the coronavirus pandemic is changing our lifestyle. As we know, we have a lot of working from home people and on-contact business, on-contact e-commerce, on-contact consumptions, and e-educations. And even we are doing webinar here instead of the real in-person conference. So how these changes, these types of changes will affect our real estate market, our existing investment and our future investment in the global real estate market. How do you think about that big question? So my first question is pretty much bigger picture about the global market and the real estate. What is your view? You can start from the macro level forecast to narrow down to the micro level, sector level. For example, as you know, the office sector, retail sector, industrial sector, hotel and lodging, there might be different effect, different impact. The levels would be different, the scales and scope would be different, risk and opportunities. What are your view? So this webinar will be operated like this. I will ask 4 global speakers, overseas speakers, some questions, some selected questions. And we will spend first 1 hour for discussion about those questions. And then following 30 minutes, last 30 minutes, we will have a free Q&A, open topic with our local speakers. So let me ask one by one. And if I call your name, you can introduce yourself, who you are, and what is your company, what you are doing. About 1 minute, 1.5 minutes. And please answer my question about the big picture of your prospect and your assessment to this global real estate market. Why don't we start from Mr. Ritson Ferguson, who is CEO and CIO of CBRE Italian Securities. Mr. Ferguson, what is your view? Who are you?
Sam, thank you. Well, first, I'm Ritson Ferguson. As you said, I am CEO and CIO of the listed real asset manager within CBRE Global Investors. We run about 10 billion of listed real estate and listed infrastructure portfolios. I have been in the alternative investment space for approximately 30 years and have had extensive experience on the private side as well as listed. So I can speak to the listed probably with greater specificity. I'll try and answer your question with some view of the private market as well. First, let me say that crystal ball is no clearer than anyone else's, and there is much that is unknown at this point in time. That said, we do feel advantaged being part of a platform with roughly 107 billion of assets under management in the global footprint and enormous resources in research and direct market activity to draw upon. But our view is that the COVID-19 crisis is likely to have as much of an impact, and in many parts of the world, a more significant impact in terms of GDP demand destruction than we saw in the global financial crisis. And that in and of itself makes this a very serious situation. The unknown is how long and how deep will that decline be, and what will the shape of the recovery. So, as I was saying, we are still trying to assess the likely impact, but we do think this is significant. And as we've seen in the listed market, there has already been a 30-35% sell-off in listed real estate, suggesting that the listed market is quite concerned. In our opinion, we believe that is probably overly discounted the decline, but to your question as to sectors and geographies, clearly the most economically sensitive sectors, so that would probably start with lodging, but would also include then retail, we see as most significantly impacted. On the other hand, in other sectors such as industrial, technology real estate, as we call it, which would include data centers and towers, the impact is relatively small. And so we see at least relatively resilience in those sectors. I'll stop there. There's much more to talk about, but I know you want to have each of the panelists weigh in with at least.
Thank you, Ritson. You will have a chance to talk about the private market and public market listed companies. What is the profits and losses these days? I'll ask you later about that questions.
Very good.
It will be interesting. And second, why don't we go to the Mr. Riaz Cassum, who is a Senior Managing Director of JLL. Mr. Cassum, are you in Boston?
Yes, sir. Thank you, Sam. I'm here in Boston, and I have been with JLL for over 30 years, the predecessor company, HFF, and now JLL for 30 years. And my area of focus is raising equity and debt capital for commercial real estate. So we're in the business of raising capital both in the US and around the globe now as part of JLL, and work on both the debt advisory side as well as the investment advisory. And we also raise capital in the form of discretionary funds through our placement agent business. So we are working with virtually every provider of capital in the world for real estate, and our clients are the major and the smaller users of capital in each of these markets. So I'll just maybe comment. We'll get into some more of the sector discussions, but of course, each of these events, whether you want to call them, macro black swan type events or major shifts in the market, there's a lot of similarities, but each time they're different in many ways. I'd say on a positive note, going into this event, which was obviously a sudden occurrence, and as someone said, once you stop the world from spinning, suddenly some things are going to shake loose and fall off. So there's no question there's going to be both some short-term, which we're feeling already, and certainly some long-term negative ramifications of what we're living through. But on a positive note, speaking for real estate, and the big difference between the GFC and now is that from a liquidity standpoint and capital formation and capital availability perspective, we're going into this crisis from a position of strength, I would say, because a lot of capital has been raised that is been allocated for real estate. And real estate's come a long way in the last 10 to 12 years in terms of becoming truly a legitimate alternative asset. It's not an alternative asset class anymore. It's its own class that actually has outperformed most other asset classes. So we see a continued focus and commitment to investing in real estate, and so I think that will certainly help us get through this and come out of it at the other end, which doesn't mean we won't have some implications of it, but we hope that the liquidity and availability will allow us to come through this less. No, that's okay. So I was just saying, I think I'm hopeful that, given the liquidity and the desire for capital to continue to invest in real estate, we should be able to come out of this, and the capital will be there to take advantage of the opportunities that this situation will present.
I see. Hey, Riaz, given the government effort, EU and the states government effort, the stimulus package and monetary policy and fiscal policy, we have a very low, historically low interest rate today. And we may have, in some day, we know, all of us knows, there will be a certain point we have inflation concern, given the liquidity and monetary easing program. So how do you think about that issue? How this kind of the government policies and macroeconomic issues will affect our real estate market in 6 months and 1 year?
It's a good question, Sam. So I meant to comment on the fact that what's also different this time around is that the Fed and the government has acted much more swiftly. So in the GFC, the crisis, if you will, developed over several months and quarters, and the response from the Fed and the federal government was slower. And ultimately, they got to where they needed to get to, but the delay in responding reduced the impact of everything that was done to address the problem. This time around, I'm actually pleasantly surprised at the swiftness with which both the Fed and the federal government has responded, because the stop was sudden, but the response was also very swift. So I think that's going to, again, help mitigate some of the challenges that we face today and going forward. So having said this, there's no question that there's a tremendous amount of liquidity that's been pumped into the economies, both in the U.S., Europe, and even in Asia, which ultimately you would think will show itself in the form of increasing inflation over time. So it's right now. Essentially, the central banks are not concerned, or seem to be less concerned about the long-term impact on inflation, which they know is a risk. But in order to deal with the crisis, they've had to run with lower interest rates, and there's talk about negative interest rates in the U.S. So we think it's a good thing to keep these rates low in the next, for the next year to 3 years, in order to get through the crisis. But ultimately, real estate has historically been a terrific inflation hedge. And so, if inflation does come back, which it's likely to, being in real estate is actually, where you want to be, given the way, leases work and rental streams work, and interest rates will go up, obviously, with inflation, but you're going to have a rising rental market. And within reason, within a 2 to 4% inflationary environment, real estate actually performs quite well. So in a sense, real estate has it going for it in the short run in terms of low interest rates to get through the crisis. And then in the longer term, when there will be inflation, it should be a good hedge against that.
I see. Thank you. Thank you for your very nice elaboration about the issue. And next, what about, let me ask, Mr. Jeff Giller, who is head of real estate, global real estate at the StepStone. Hey, Jeff, how do you
Hey,
think
Sam.
about that?
What do I think about it? You asked a very
Please
broad
introduce
question.
yourself first.
Okay, great. So I'm Jeff Giller. I head StepStone Real Estate's practice. And StepStone's a global private markets firm. We cover not only real estate, but private equity, infrastructure, and private credit. So we're a global firm. We have 19 offices around the world on about every continent. We have about $280 billion in assets under management and assets under advisory. About 62 billion of that's AUM. And importantly, we put out about $50 million a year into the market, into funds. So we have a very strong look into the world of funds and what limited partners are doing, and being able to understand the impact of the crisis across all of the private markets area is very, very instructive to us. So StepStone Real Estate is the real estate practice of StepStone. We have about 100 billion of AUA and AUM. And we invested last year about $13 billion into funds and into secondaries and co-investments. And our practice is really divided into sort of two pieces, but highly integrated. A real estate advisory business where we're effectively a traditional gatekeeper for institutions investing into funds. So we help them decide on their strategic asset allocations or tactical plans and help them deploy money into the markets. And then we have a fund management business in a separate account as well, where we really focus on secondaries, recapitalizations, and co-investments. So that's really StepStone Real Estate. I'm a 35-year veteran of the industry. I have been through, I guess this is my third major downturn now. And so there is a tone and tenor and a pattern to these 1 in 20-year turning to, I guess, 1 in 10-year events that I think we can all, those of us been through have seen and recognize. I thought it would be, well, first of all, I thought I'd just briefly share with people what we're telling our clients to do, the advice we're giving to our clients. And first and foremost, it's stay the course. During the global financial crisis, institutional investors were somewhat, inexperienced with this kind of a crisis, and they froze and they weren't prepared with liquidity. So they stopped investing and they told their managers to stop investing, and they even stopped agreeing to contribute their unfunded commitments into rescue situations in their funds. So it really resulted in some counter-cyclical behavior where institutions stopped investing at exactly the time they should have invested. In this market cycle, clearly we've all learned, and we're advising our clients to not alter from their annual pacing plans, but of course, stop and shift how they're thinking of investing tactically. Where they're investing, what they're investing in, and really allocating to maybe a different set of managers that are proven and practiced at investing in this kind of environment. We could talk later about what those strategies might be, but really staying the course is key. Also, as we know, all being real estate veterans on this call, that it is real estate's not like the public securities markets that Ritson's maybe more familiar with, or at least more recently familiar with, but it's a long, slow moving train to distress and capitulation in real estate. So it is, not time to jump on opportunities now. We don't think it is. We're going to have to wait for the distress to work its way through the system, and for distress to hit individuals, businesses, then landlords and banks, and eventually capitulation. So I think we're all sitting around and waiting. And as Riaz said, a lot of dry powder, a lot of capital on the sidelines that are doing just that, waiting to pounce on the opportunity. And I'll just kind of end this intro by talking about what the differences, I think, are between this crisis and last crisis. And a lot of it's reiterating what other people have already said. So I'll be brief. But I think one big difference is that we are all more experienced. We are all going into this with some experience. During the global financial crisis, there was about a 15 to 17 year run, a bull market run that had happened, and there was a whole generation of real estate professionals that had actually gotten to be pretty senior by the time the GFC hit that had never seen a market downturn and never thought it could happen. So there was, as Greenspan put it, irrational exuberance investing into that market because there was a whole class of professionals that didn't think real estate could ever do anything but go up and up. So they over-leveraged, they overbuilt, and they paid ridiculously low cap rates for real estate and then didn't know what to do when the crisis hit. Well, sadly, we didn't get to go another 20 years this time, although I think many of us thought we would. And it was 10 years, and everybody, even mid-level people, know what to do in a crisis. So we've got the toolbox. I think another difference between this and the global financial crisis is going to be the depth of the recession. I think we all thought it was going to be a V-shaped recovery, and now we think it might be a U-shaped recovery. I mean, there's been nothing like this where there's been automatic 30% unemployment, and even when the economies open up, people aren't going back to shop and to work and to buy. People are going to stay inside, and spending's going to drop. So I think we're headed for a really big recession relative even to the global financial crisis. Finally, just the last 2 points. Again, weight of capital. When the buying opportunities come, don't expect to be able to buy at super distressed pricing and get 30 IRRs, because there's going to be a lot of competition for every deal that comes to the market. There's just so much capital waiting to pounce on this. And totally agree with Riaz that the government is much better suited, is handling this much better with fiscal and monetary policy than they did during the global financial crisis. So I'll end that introduction.
Okay, thank you, Jeff. Last Brant, do you agree with Jeff Giller? Should we stay at the course, not the market timing? Isn't this a good market to jumping in? Please tell us. Yes. Please introduce yourself.
No, I'm Brant Maller. I have a somewhat different perspective on this than some of the other folks. My background actually was in real estate for many years. I'm a lawyer by background, but I created an investments think tank. I sat on investment and investment advisory boards for the big 3 U.S. public pension plans, and somewhere along the way created something that morphed into an investments think tank. And Sam is actually involved in it. So my perspective is really talking to the world's largest investors across their portfolios, particularly the portfolios that either invest in illiquid assets or invest in liquid assets that are held through illiquid structures. And real estate obviously cuts across those core categories of private equity, private credit. What I used to call hedge funds, I'll call diversifiers or opportunistic, infrastructure and real estate. And so there's a lot of crossover there. I think that a lot of the comments that I'm hearing that I've heard today are very consistent with what we hear throughout the world with large investors that we talk to. I think that people are right in the middle of a lot of volatility right now. So I don't think institutional investors are eager to jump into the breach and take big positions at the moment. They're kind of sitting back and seeing how this thing plays out. As Jeff said, there is a lot of liquidity, particularly, I think we work a lot with StepStone, with Jeff's firm. In fact, one of their founders helped me launch IF a million years ago. And private equity, I think, has got $2 trillion sitting out there from the numbers that they throw around. So it's crazy. So we spend most of our time with chief investment officers, and we've been thinking lately. We're actually working on a program which you're all welcome to listen in on next week with Harvard Business School professor Andre Perot, who wrote an article on rebalancing, portfolio rebalancing, with Bill Sharp, Nobel laureate, and Britt Harris from UTIMCO is going to be part of that with Sarah, with LA County CIO. But anyway, we've been having a lot of conversations about, are you rebalancing? How are you rebalancing? When are you going to rebalance? The strong consensus is that these people are staying pretty strategic with their asset allocations. And whatever they're doing, however they're tweaking it, it's being more really more through active management, more short-term stuff. That tends to be what we're hearing. As far as real estate goes, I mean, obviously real estate is debt, equity, public, private, domestic, international. On the debt versus equity side, I think the trend that I've observed is that the private credit has been an enormously popular asset class that's really evolved over the last 2, 3, 4 years. And it's quite fascinating to watch because I feel like absolutely every major firm has been out there raising a private credit fund. And some of them are making loans that are, they're single digit coupon loans where they're promising their investors double-digit returns, which pretty immediately implies leverage. So I would think that some of these folks are quite leveraged. Another thing that I'm kind of interested to watch play out is some firms are, have the ability to work out bad loans, and some other firms that have raised private credit funds are pretty much specialists. So I'm curious when they actually have to deal with distress within their portfolios, which I assume they will pretty quickly, since some of them are probably not, no cash flow for some of their borrowers. That is something that we're watching. I don't know how soon the distress happens from the dislocation. I think the consensus we hear is similar to what we heard from the other panelists, which is it's not right away. It'll take a little time, although obviously there are some real estate food groups. I mean, hospitality, needless to say, retail, office is one that I've often wondered about. I think that the long-term or the 10-year nature of lease obligations in the U.S. has masked the effect of the internet on office space. Now that we've found out that people can work remotely from their homes, I don't know how many people really need to pay $100 a square foot to have a junior associate sitting in Midtown Manhattan. So we'll see where that those markets go at the margin. I also agree versus the GFC. I still remember very vividly dealing with chief investment officers during the global financial crisis who were really asking each other about whether they had bank lines of credit or how they would get enough liquidity to pay their pensioners. I think that most of the folks I know have been preparing for the bull market to since about 2014 or 2015. So they have much more cash buckets, or they're more liquidity, because they've kind of been positioning it for a downturn. They didn't expect it to come this violently or this quickly. And I'm just looking at whatever else I have here. One thing that I heard in another big asset management firm talking about, which I thought was kind of interesting, was this whole notion of what they call deglobalization, right? There's been this wealth transfer of, the number they used was $1 trillion from developed countries into more emerging countries, which has hollowed out the middle class of a lot of the developed countries and has created a lot of the struggles that have caused us to see, populist candidates get elected in the United States or England, I think Italy, other countries. And what they did, they took it a step further, and they started looking at the characteristics of the countries and whether they were net importers or exporters. And they actually thought the United States was rather well positioned because the United States is a net importer. I think only 25% of our GDP was based upon exports. At least that was the number that they were using. This was Wellington. So I thought that was an interesting thing to think about because their sense was, and we heard this last week. We had 3 major plans last week talking about, yesterday, talking about credit, and a number of them were saying, it used to be that everything was expensive and there weren't any opportunities anywhere. Now there are going to be tons of opportunities, and maybe they don't need to really look overseas or look at complex things or try to capture really illiquidity premia, because there are going to be a lot of opportunities shaking loose. And I hear what Jeff said about there also being a lot of money out there chasing those opportunities, so that will create an interesting dynamic. But I do think that was the consensus that we got. Last thing I'll say, inflation is wondered about. When the CIOs, for instance, Ash Williams from Florida, who chairs our board, his view was there's going to be so much supply and demand destruction that inflation is probably less of an deflation over at least near term. I don't know that I do actually hear folks feeling that way, but I also wonder about all this flooding the system. Last one for me is also ESG, which is a topic that seemed like it was front and center for everybody before this hit. And there's kind of a split of opinion about whether that becomes sort of a high-class problem. Okay, well, my last point was simply ESG, which is a topic that, as you know, investors the world over have been struggling with. I wonder where that one goes if it becomes kind of a high-class problem, where if you're worried about just paying your bills, ESG becomes less of an issue, or to some extent, some of the social issues created by public health pandemics makes it, all the more important to some places. So that's again, just all larger trends that I'm hearing about from CIOs.
Okay, thank you. Thank you, Brant. You touched a lot of different area here, not only real estate, even the politics, global economy, and everything. So appreciate.
All I think that will touch upon how one thinks about their real estate portfolio.
Correct. I agree. And so far, four of you introduce yourself and give us a brief picture about your idea, real estate market. And some of you mentioned very interesting part. And let me summarize that. The one question I'm raising here is the real estate investment through the debt market and equity market. The impact will be different. And from the last financial crisis, GFC 1 and 2, we learned the huge leverage, over-leveraged investment has a tremendous problem. What is the situation today in the real estate market? Do we have leverage control? I know from the media, there is a CMBS market shrinking and illiquidity problem increase compared to the beginning of the year in the States. What's going on in the debt market, the private debt and public debt in the real estate market? Why don't we start from Mr. Ferguson about that issue? And then let me say, any one of you can interrupt my operation from now on. And then you can you can ask Mr. Ferguson's elaboration anytime. So let's do the free discussion from now on. Ritson, what is your view?
Especially on a topic like debt, I think there will be many who can add. First, let me say that I do believe we enter this downturn in much better situation than the global financial crisis. In fact, mortgage-backed securities were very much at the center of that, financial market-driven downturn. And while there have been, some press articles about mortgage REITs and some potential defaults in CMBS, by and large, the amount of leverage being used in the system is less. With using listed market companies as an example, going into the global financial crisis, I think the average listed real estate probably had 45% debt against 55% equity. When you have a 25% hit to gross asset values, that suddenly turns you into 60, 70% levered, and new issues and covenant problems arise. That's not the case. The listed companies going into this had, in general, somewhere between 25 and 30% leverage. There are exceptions, certainly, to that rule, but by and large, we do not see leverage issues driving listed real estate to recapitalize at very depressed rates the way we did before. We actually do think this is an interesting time to be a lender to real estate. I think it's an interesting opportunity for putting out new loans in a marketplace that, clearly will have some dislocation from those public market sources. But again, I don't sense that there is a rush of distress, and so we see the opportunity for mezzanine loans, B-piece loans as a very interesting way to potentially lock in high single-digit returns and potentially in some circumstances low double-digit. But again, main point, I don't see the distress levels outside of some like lodging, perhaps B malls at this point that you might have been thinking about if you were thinking this was a repeat of the GFC.
I see. Thank you.
If I could, I'd make a couple
Riaz?
comments.
Yes.
So I agree with what Ritson just said. So it's interesting what's going on in the debt space. So I agree that we are going into this as owners of real estate with not a very heavy debt load like we did the last time around. And what's happening in the last 60 days, as we've seen, most lenders have been dealing with a request from borrowers, primarily hospitality, retail, and to some extent office, with requests for forbearance agreements and restructuring their debt. And because of the situation, because of whether it's the pressure from the Fed or just because it's a human tragedy here, if you will, the lenders are being very accommodating to these owners. So at least for now, I think in the next 6 months you will see more distress. But to Ritson's point, we haven't seen any significant amount of distress, and to the extent there was distress, which was primarily in the debt fund space, where the debt funds themselves had over-leveraged their positions using their repo lines or the CLO market, they had to actually move some paper to create liquidity for themselves. And what's happened in the last 45 days in the market is that, CMBS or just mortgage spreads have gone from, the AAAs went from 95 over to 215 or 20 over.
Right.
But very quickly came back, and this week they're priced at 145 over. So to the point I made earlier, and Jeff made, the capital is sitting and actually waiting to deploy. And right now, because it's hard to value equity real estate because nobody knows how to value that, and that price discovery process will take another 6 months or so, it's easy to play in the debt space because you have that margin of error and you can buy into some good yielding positions, but there's not much of it. So a lot of capital flooded in the last 4 weeks, and it happened on the listed equity side as well, and sort of wiped out that opportunity very quickly. So we're going to, I think it's going to come in spurts, and eventually it will build on it. But for now, it seems like a lot of the equity that's sitting on the sideline would prefer to play in that mezzanine debt, rescue capital, but come in a debt structure so that you have that margin of error and you don't have to price the asset to perfection to buy it.
I see.
I'll just jump in. Why not be somewhat controversial? Take issue with some of the prior comments, just for argument's sake. But I think it's really hard to call the market, 8 weeks into this pandemic, right? And the fact that the lenders haven't forced borrowers into restructures or foreclosures yet it's probably much too early to make that call. Rent collections through May 1st have been very strong. And that's just because the impact of the recession really hasn't hit tenants in the way it is likely to. I mean, office is still sitting at about 90%, multifamily is still sitting about 80%, hotel and retail, of course, is a different story. So as distress works its way through the occupier market, then you're going to see the banks that are going to probably be in a position where they're going to be much tougher. Eventually banks are going to have capital ratio issues, and they're going to need to bring, liquidity back into their system. But I just think it's too early to tell. And I also think that the bounce back in the AAA tranches of CMBS, that was largely due, I think, to government support through open market purchases by the Fed through the TALF program. So I don't necessarily see that as a market dynamic as much as as intended by the government to help support those positions.
I see. Thank you. Any other comments on this issue? Leverage and debt?
Maybe just building a little on Jeff's comment, Sam. I do think the thing that is very interesting here, the central bankers have deployed some of those new tools learned in the global financial crisis. So we have more intervention kind of across the credit. I mean, it is amazing to me, 2 months into this downturn, that in the U.S. market, the BAA bond yield is essentially unchanged from where it was at the beginning of the year. In the global financial crisis, we saw those spreads blow out, even for investment grade rated. That did happen, but because the monetary authorities are in the market, buying or at least talking support to buy those things, we see much more stability. So I agree with Jeff's comment that it may be early, but on the other hand, I do reinforce that things are different. Remember, just before the global financial crisis, we saw Blackstone take EOP private in a highly leveraged transaction. Now, they did some very deft sell-off of that portfolio and kind of managed to avoid that, but we don't have the same sort of, highly leveraged acquisitions in the marketplace that create that. And in many cases, like the European banks, the banks were never able to get back involved in the real estate markets at the same levels as before. And that's why I have a little more optimism that this time the distress in the credit markets outside of, again, some of those highly impacted, economically sensitive sectors will not probably be as pervasive as what we saw in the GFC.
I think it's a complete function of how far property values drop, period. Because I'm thinking about the opportunistic and value add space. Average leverage levels pre-GFC were, call it 75%, and now call it 60-65%. So there was much more prudence in terms of borrowing.
Hey, Jeff, you said 60 to 65 every leverage today.
In the value add opportunistic sector. Right. Clearly in the core plus, probably more like 50%, and in the core space, more like 25%. But if you look at the value add opportunistic space, which is where the distress will occur, 65 or 75%. So you're talking about maybe a 10% delta in value declines before real pain hits. So if this recession, if the real estate recession ends up being worse, we're going to push through that 10% cushion pretty quickly. If not, you're right. We're much better positioned, I think.
All right. Thank you. Good discussion.